In 2026, more Canadians are closer to financial collapse than at any point in modern history. Household debt is at record highs, mortgage payments are exploding, and savings accounts are quietly being drained just to survive. For the first time, experts warn that losing your home, your pension, or your life savings is no longer a worst-case scenario. It's becoming a common one. What's even more alarming is how fast this is happening. Across Canada, families who believe they were financially safe are now facing impossible choices: pay the mortgage or buy groceries, dip into retirement funds or fall behind on bills, sell the house or drown in debt. This isn't caused by one single event. It's the result of multiple pressures colliding at the same time in 2026. The most dangerous part? Most people don't see what's coming next. Stay with me, because the final reason in this video explains why this crisis could hit even those who think they're prepared. Number 1. Mortgage renewal shock. Right now, millions of Canadian homeowners are walking into the most dangerous financial moment they've ever faced. Mortgages that were locked in at 1 to 2% interest rates during the pandemic are expiring in 2026, and they are being renewed at double or even triple the cost. That means families who were paying $2,000 a month are suddenly staring at payments of $3,000 or more, without any matching increase in income. This isn't about overspending or bad decisions. It's a systemic shock hitting ordinary households all at once. Behind the scenes, banks and lenders are quietly preparing for a wave of financial stress. Many homeowners are already extending amortizations, draining savings, or adding debt just to stay afloat. Forced renewals are happening in a weak economy, where wages have not kept up with living costs. Research from housing economists shows that payment shock is one of the strongest predictors of mortgage default, and 2026 is the peak year when this pressure fully hits. For households caught in the middle, the emotional toll is just as heavy as the financial one. Anxiety, sleepless nights, and constant budgeting have become the norm. Some will downsize, others will sell under pressure, and many will watch years of hard-earned equity disappear. This is why the mortgage renewal wave is not just a housing issue. It's the foundation of the 2026 financial crisis in Canada. If this reality hit close to home, share your thoughts in the comments. And please subscribe. It's one click that helps us keep creating deeply researched videos like this for you. Number 2. Housing wealth is evaporating. For years, Canadian homeowners were told their house was their safest investment, their backup plan, and even their retirement strategy. But in 2026, that belief is being quietly dismantled. Home prices are no longer surging. They are slowly sliding or stagnating, while ownership costs keep climbing. Property taxes, insurance premiums, utilities, and maintenance are eating away at value, turning home from wealth builders into financial burdens. On paper, prices may look stable, but in real terms, housing wealth is shrinking. Unlike a sudden crash, this phase is more dangerous because it goes unnoticed. Owners don't panic sell. Instead, they wait, hoping values will rebound. Meanwhile, inflation erodes purchasing power and interest costs rise. Studies on asset deflation show that prolonged flat markets often cause greater long-term damage than short crashes because households keep spending as if their wealth still exists. In 2026, many Canadians are discovering that the equity they plan to rely on is no longer accessible without serious losses. Emotionally, this creates a deep sense of betrayal. People delayed savings, took on larger mortgages, or skipped diversification because housing felt guaranteed. Now, refinancing is harder, selling is riskier, and downsizing doesn't deliver the relief it once did. When housing wealth weakens, the entire financial system feels it, from consumer spending to retirement security. This silent erosion is why so many Canadians feel poorer, even if they haven't lost their home yet. Tell us in the comments, do you still see housing as a safe investment in 2026? And please subscribe to support the countless hours we put into bringing you clear, honest analysis with just one click. Number 3. Pension system under strain. For decades, Canadians were promised that pensions would provide stability, dignity, and security in retirement. In 2026, that promise is being tested like never before. Public and private pension funds are under growing pressure from market volatility, longer life expectancy, and weaker long-term returns. Many funds assume steady growth that simply hasn't materialized, and the gap between what pensions owe and what they can realistically pay is quietly widening. Meanwhile, investment conditions have fundamentally changed. Bonds, once considered the safest backbone of pension portfolios, suffered historic losses after years of interest rate hikes. Equity markets remain unstable, swinging between optimism and fear. Research from actuarial and financial institutions shows that when returns underperform for several years in a row, pension sustainability weakens rapidly. In 2026, some funds are being forced to reduce future benefits, increase contribution requirements, or delay retirement eligibility, shifts that directly affect millions of workers and retirees. Emotionally, this hits people at their most vulnerable stage of life. Many Canadians planned carefully, contributed consistently, and trusted the system to work as designed. Now, retirees are discovering that their pension income buys less each year, while those still working face uncertainty about what they'll actually receive. When pensions wobble, confidence collapses, and households become more cautious, slowing the entire economy. This is why pension stress is not just a retirement issue. It's a national financial risk unfolding in real time. Drop a comment and tell us, do you trust pensions to protect retirement in 2026? And please subscribe to support the deep research behind these videos. It's just one click, but it helps more than you know. Number 4. Inflation that never truly left. Many Canadians were told inflation was under control, but in 2026, everyday life tells a very different story. While headline inflation numbers may look calmer, the prices that actually matter, food, rent, insurance, utilities, and transportation, remain painfully high. This is known as persistent or embedded inflation, and it slowly drains household finances without triggering public alarm. People aren't buying luxury items less. They're cutting back on basics just to keep up. At the structural level, economists point to supply chain restructuring, higher energy costs, climate-related disruptions, and rising insurance risks as key drivers. These forces don't disappear when interest rates stabilize. Studies show that when essential inflation stays elevated, households experience a sharp decline in real purchasing power, even if wages increase slightly. In 2026, many Canadians are earning more on paper, but feeling poorer in reality, as paychecks fail to stretch to the end of the month. Psychologically, this creates constant financial pressure. Families dip into savings, rely on credit, or postpone long-term plans simply to manage routine expenses. Over time, this behavior compounds damage by eroding emergency funds and retirement contributions. Inflation that lingers is more destructive than inflation that spikes, because it normalizes struggle and delays corrective action. This silent squeeze is one of the clearest reasons why savings and financial stability are vanishing across Canada in 2026. Let us know in the comments which everyday cost has hit you the hardest this year. And please subscribe to support the work behind these videos. It's one simple click that makes a real difference. Number 5. Household debt reaching the breaking point. Across Canada in 2026, household debt is no longer just high, it is unsustainable. Years of easy credit encouraged families to borrow against homes, incomes, and future expectations. Now, with higher interest rates and stubborn living costs, the debt is demanding repayment all at once. Credit cards, lines of credit, and variable rate loans are consuming larger portions of monthly income, leaving little room to breathe. Beneath the surface, financial data shows a dangerous shift. Debt servicing ratios are climbing, meaning Canadians are spending more of every dollar just to pay interest, not reduce balances. Studies in behavioral finance confirm that when households cross this threshold, financial stress accelerates rapidly. In 2026, many families are not accumulating new wealth, they are simply rotating debt, moving balances from one account to another in an attempt to stay afloat. Emotionally, debt changes how people live and think. It limits choices, delays major life decisions, and creates constant anxiety about the next bill or rate increase. Savings vanish first, then investments, and eventually assets. When debt reaches this level, even a small shock, a job loss, illness, or emergency, could trigger collapse. This is why record household debt is not just a personal issue. It is a central force behind Canada's growing financial instability. Share in the comments, does debt feel heavier now than did a few years ago? And please subscribe to support the research and effort behind these videos. It's just one click, but it helps us continue. Number 6. Rising job insecurity. Employment in Canada in 2026 is far from stable. While unemployment numbers may seem moderate on paper, the reality for many workers is very different. Jobs are increasingly temporary, contract-based, or subject to automation, leaving workers unsure if their income will last month to month. Even positions that once felt secure are now vulnerable to AI integration, outsourcing, and corporate downsizing. For millions, the steady paycheck that supported mortgages, savings, and daily life is no longer guaranteed. Economists warn that this type of silent job erosion is more dangerous than mass layoffs because it develops gradually and often goes unnoticed until households are already strained. Income volatility prevents long-term financial planning, discourages savings, and makes debt repayment even harder. Recent studies show that when workers cannot reliably predict their earnings, stress levels rise, spending patterns shift, and economic participation slows, creating a ripple effect across the entire Canadian economy. On a personal level, the stress of uncertain employment affects decision-making and mental health. People delay buying homes, pause retirement contributions, and often tap into emergency funds to cover basic expenses. This hidden labor market instability is a key reason why millions of Canadians feel financial pressure building in 2026, even if they are technically employed. Job insecurity is quietly undermining the foundation of household stability, pushing families closer to financial collapse. Comment below. Have you felt your job security weaken in 2026? And please subscribe to support the effort behind these in-depth videos. One click keeps us bringing you critical updates. Number 7. Government support is shrinking. In 2026, many Canadians are discovering that the financial safety nets they relied on in past crises are no longer as robust. High national debt, rising interest obligations, and limited fiscal flexibility mean that governments simply cannot provide the same level of stimulus or assistance as before. Programs that once helped households manage mortgage stress, unemployment, or emergency costs are being scaled back or tightened, leaving millions exposed. Financial analysts point out that shrinking government support coincides with rising living costs and stagnant wages, creating a perfect storm for households. Unlike previous crises where temporary aid helped Canadians stay afloat, the current environment offers minimal relief, forcing families to rely on personal savings or credit. Studies show that when public support diminishes during periods of economic stress, default rates, evictions, and bankruptcies increase sharply, and 2026 is proving to be no exception. For the average Canadian, this creates a stark reality. The social safety net is no longer a reliable fallback. Families must navigate rising costs, mortgage shocks, and personal debt without expecting government assistance to catch them. This lack of institutional support magnifies every other financial risk, from housing to pensions, and is a major factor behind Canada's deepening financial strain this year. Tell us in the comments, have you noticed government support shrinking where you live? And please subscribe to help us continue delivering detailed, researched videos like this. It only takes one click. Number 8. Savings are being drained. In 2026, Canadians are facing a harsh reality. Many are no longer saving for the future. They are spending their savings just to survive. Emergency funds, retirement accounts, and investment portfolios that once offered security are being tapped to cover rising bills, mortgage payments, and unexpected expenses. Even households that carefully planned for years are now forced to dip into funds meant for long-term stability. Financial reports show a worrying trend. RRSP and TFSA withdrawals have surged, while contributions have stalled. Canadians are using their hard-earned money as a short-term lifeline, eroding years of financial planning. This constant depletion makes it nearly impossible to rebuild wealth, leaving families vulnerable to even minor financial shocks. Experts warn that once savings are exhausted, households are more likely to rely on debt, further compounding financial instability. Emotionally, watching savings disappear creates anxiety and fear. Plans for retirement, children's education, or home improvements are postponed indefinitely. When savings are drained, financial freedom vanishes, and Canadians are left trapped in a cycle of living paycheck to paycheck. This silent crisis is a key reason why the 2026 financial disaster is impacting millions across the country. Share your experience in the comments. Have you had a dip into savings this year? And please subscribe to support the research and effort behind these videos. It's just one click to keep this important information coming. Number 9. Immigration and housing pressure. Canada's population continues to grow rapidly in 2026, driven in large part by immigration. While this brings economic benefits, it also intensifies housing demand and increases competition for rental units and affordable homes. Cities that were already struggling with tight housing markets are now seeing rents and property prices rise faster than wages, putting even more pressure on Canadian households. For many, finding a home within budget feels impossible, and existing homeowners face higher property taxes and living costs to support infrastructure expansion. Economists note that this mismatch between population growth and housing supply creates a systemic strain on affordability. While immigration policies are carefully managed, the lag in building new homes or upgrading infrastructure means supply cannot keep pace. Families who believe they had stable living arrangements now find themselves competing for limited options, forcing some to relocate, downsize, or pay more than they can comfortably afford. On a practical and emotional level, this stress compounds other financial pressures. Higher housing costs eat into savings, reduce discretionary spending, and increase debt reliance. The combination of population growth and housing shortages is quietly pushing Canadians closer to financial instability, even for those who seem prepared. In 2026, this is one of the less obvious but most impactful drivers of the country's financial crisis. Comment below. Have you felt housing pressure rise where you live? And please subscribe to support the effort behind these videos. It's just one click to help us keep delivering crucial insights. Number 10. The hidden crisis, financial fatigue. Beyond mortgages, debt, and rising costs, Canadians in 2026 are facing a silent but powerful threat, financial fatigue. Years of constant stress, uncertainty, and juggling expenses have left many households mentally and emotionally exhausted. Even small financial decisions feel overwhelming, and the ability to plan for the future is steadily eroding. This isn't just a personal problem, it's a national concern, because decision-making under fatigue often leads to mistakes that deepen financial instability. Research in behavioral economics shows that when people are financially stressed over long periods, they are more likely to overspend, delay investments, or make reactive choices that harm long-term stability. In 2026, Canadians are cutting corners, postponing retirement contributions, and relying on credit simply to get through the month. This hidden crisis magnifies every other problem. Housing pressures, debt, inflation, and job insecurity all feel worse when people are mentally depleted. The most alarming part is that financial fatigue is largely invisible. Neighbors may appear fine, friends may keep up appearances, and government statistics can't capture the emotional toll. Yet it affects millions, silently undermining household stability and resilience, making recovery harder and slower. This hidden psychological factor is one of the final overlooked pieces of the 2026 Canadian financial disaster puzzle. Let us know in the comments, are you feeling the weight of financial fatigue this year? And please subscribe to support the hours of research and effort behind these videos. It only takes one click to help us continue. As we've seen, 2026 is shaping up to be one of the most challenging years for Canadian households in decades. From soaring mortgage renewals and eroding housing wealth to pension strain, persistent inflation, and record household debt, the pressures are coming from every direction. Even for those who thought they were prepared, the combination of rising living costs, shrinking government support, and job insecurity is creating a perfect storm. This isn't a distant warning. It is happening right now, and millions of Canadians are already feeling the consequences. The ripple effects extend beyond personal finances. Families draining savings and relying on credit weaken consumer spending, slowing economic growth and increasing financial risk across the country. Rising housing pressures and population growth make affordability a daily struggle, while the hidden cost of financial fatigue erodes decision-making and long-term planning. Each factor alone is concerning, but together, they form a comprehensive picture of instability that cannot be ignored. What's particularly alarming is how quickly ordinary households can move from stability to vulnerability when multiple pressures converge simultaneously. However, while the situation is serious, awareness is the first step toward protection. Understanding these 10 factors allows Canadians to take proactive measures, reviewing budgets, reassessing debt, protecting savings, and planning for alternative income sources. Knowledge and preparation can reduce the impact, even if the broader economic environment remains challenging. The key takeaway is clear. The financial landscape of 2026 demands attention, action, and careful decision-making to safeguard homes, pensions, and personal savings. Ignoring the warning signs will only make the situation worse. We want to hear from you. Which of these 10 challenges hits hardest for you in 2026? Watch our previous video to stay informed, and please subscribe to support the hours of research and effort behind these videos. It's just one click, but helps us keep bringing you vital updates.